So it doesn't mean you won't have a cyclical bull market or a money-making opportunity in the indexes. But if you ride it all the way down, that's not going to get you back to even. You're still going to be well below even, I think. Whereas if you're in a more narrow group of stocks that are, let's say, commodities, the next cycle, those could go on to major new highs. So, I'm calling for gold to go to 20,000. I'm calling for silver to go to 500. So even if you rode through the bear and rode through the bust and bought and held, those things, you will be fine. You'll just have to deal with the negative period that you won't feel very good. Your portfolio's gone down.
David Hunter, known for his bold macro calls, emphasizes that long-term positioning matters far more than surviving every downturn. He acknowledges that cyclical bull markets can appear even amid broader declines, and that traders can still make money in the indexes. But riding equity markets all the way down through a major bear cycle, he warns, won't bring investors back to even. Structural damage takes too long to repair. In his view, the next authentic leadership will come not from broad equities but from a narrow band of commodity-driven assets poised for a historic reset. Hunter reiterates his extreme but calculated outlook, gold pushing toward $20,000 and silver advancing toward $500 in the coming cycle. He argues that even if investors endure uncomfortable drawdowns along the way, simply holding through the turbulence will leave them far ahead once the secular move unfolds. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
It's been a tremendous run this year. The miners have finally started to catch up to the metals. Gold's done very well, as we know. Has been up to 4,400, I think. And silver, which had lagged, has done a lot of catch up in the last several months. We've gone through a correction here. You got a lot of people calling for lower prices on gold and silver, lower prices on the metals. My look at it is that we are at that inflection point here too. I think as of today, you may have bottomed out in the miners. And I think there's a big run ahead. I think the biggest part of the run in the miners is ahead. As big as, some of those have doubled and tripled off their bottom, some more than that. And yet I still think the biggest move is ahead of us, and ahead of us in the next 6 months. It's not, 2 years ahead, 3 years ahead. They will get hit in a global bust, which is what I'm expecting after this, sometime next year. But before that, there's big upside in the miners. My target on gold, was 5,000. That's but I think that may prove conservative. I raised my target back in early October in my fourth quarter letter. On silver, I raised that to $100 from $75. And I'm pretty confident we're going to see that in the next, several months. So there's basically silver took a while to get to new highs, but it's finally at all-time highs, as well as gold. And I think now there's clear sailing for both of them. It'll be decades. I don't know whether it's 2 decades, 3 or 4 or more. But I'm pretty sure, because of what's coming, it doesn't mean all things are not going to be up at new highs, but the broad indexes, the S&P, the Dow, the NASDAQ, those indexes, I think, are going to be decades before you see the highs that you see in this cycle. So if it's 9,500 on the S&P and you go down 80%, let's round the number. Let's say it's 10,000 on the S&P. You go down 80%, that's 2,000. You can come out of the bottom of this bear market and see the market triple or quadruple off that bottom. So it could go from 2 to 6,000 or 2,000 to 8,000 and still be far below the peaks of this cycle. So it doesn't mean you won't have a cyclical bull market or a money-making opportunity in the indexes. But if you ride it all the way down, that's not going to get you back to even. You're still going to be well below even, I think. Whereas if you're in a more narrow group of stocks that are, let's say, commodities, the next cycle, those could go on to major new highs. So, I'm calling for gold to go to 20,000. I'm calling for silver to go to 500. So even if you rode through the bear and rode through the bust and bought and held, those things you will be fine. You'll just have to deal with the the negative period that you won't feel very good that your portfolio's gone down. But so it really makes a big difference what you're owning going into the bust and then what you're owning on the other side of it. In terms of but I do want to stress, people hear dire things like 80% and never getting back to those highs or not for decades. That does not mean there's not investment opportunities in the next several years. There's going to be some very big opportunities. It's just going to be in a different manner. You're going to have to kind of adjust to the different kind of a cycle that you're going to be in, because it is going to be what happens is in the bust, the central banks around the world are going to have to respond to the bust with all kinds of money. So similar to 2020, similar to 2008-9, you're going to see massive money, except I think it's going to be 4 times what we saw in 2020. So massive money. It will trigger a rebound. It will trigger a recovery cycle. It will trigger a new cyclical bull market. But it also will trigger an inflation cycle, the likes of which we haven't seen in this country. So if in the early 80s we got up to the 20% inflation, I think this time around we might get up to 25% inflation by the early 2030s.
David Hunter notes that, despite volatility, the precious metals sector has reached a decisive turning point. Gold and silver have both pushed into fresh all-time highs, and while corrections have shaken out weaker hands, he believes the miners have only just begun their strongest phase. Even after many names have doubled or tripled from their lows, Hunter expects the most powerful surge to unfold over the next 6 months, driven by tightening supply, accelerating demand, and a looming macro reset. His long-term view remains extreme but consistent, gold advancing toward $20,000 and silver reaching $500 as the next commodity cycle matures. At the same time, he warns that broad equity indexes may take decades to recover their current peaks once the global bust unfolds. Let's get into the interview.
It will be less than some because the top end are going to get hard, but they have more to be resilient with. The guys that are struggling now are going to continue to struggle because in the downturn, because downturn hits everybody and it's the poor the hardest because they don't have the wherewithal. Longer term, I think you are going to see the gap close somewhat. Because think about it, if the market's down a lot, who does that hit the hardest? It's the high end. If real estate gets hit, and I think home prices in the U.S. could drop 30 to 40% in the next 2 years, that's going to hit those that have the home equity and are feeling somewhat like they have some wealth the hardest. So you close that gap, but it doesn't mean the other people are gaining. They may be not losing as much, but so the gap's closing, but they're not feeling better. However, and it's what I say all the time is we're coming into some very hard times. If you get this kind of a scenario where the market gets hit hard, home prices get hit hard, the economy's going to be facing inflation. And then after that, I think even a depression in the mid-2030s, the best thing you can do is not get yourself caught up in debt, try to reduce your debt, try to take advantage of these changes in the markets where you can get into the things that are going to work, and try to get your financial house in order to be able to withstand what I think are going to be tough times. I will say the Trump administration is trying to bring back middle America. I mean, it's been 40 years of very bad policies. A lot of it was the whole comparative economics theory of, send your manufacturing out to the places where you can do it cheapest, because, whoever can do it cheapest, that's okay. And then, you make your money here on Wall Street, et cetera. Well, that really benefited Wall Street. The corporate earnings went up, but it gutted our middle class. It gutted our middle America. And a lot of these cities are burned out cities that are, very drug infested and crime infested because people lost hope. And so Trump is trying, through tariffs and through these other deals, try and bring capital back into this country from foreign investors. he's trying to rebuild that as fast as he can. And that's where a lot of the criticism is people see what he's doing. It looks reckless or looks a little chaotic, but that's what happens when you have to do it quickly. We don't have the luxury of decades to do this, which is how it would normally play out if you reverse things. He's trying to do it faster. I think it's the right policy. Hopefully the Supreme Court allows the tariffs to proceed. We'll see. But people need to be patient because it doesn't happen overnight, even if he is doing it quicker than anybody else could do it. But that is the goal, is to try to level the playing field, bring back Main Street somewhat at the expense of Wall Street. He's not trying to hurt Wall Street, but they've had great time. That's why we've got a 43-year secular bull market. But Main Street's really suffered, and it's been both Democrats and Republicans have allowed this on their watch for decade after decade. And basically, it was the economic theory out there that comparative economics works. If the whole globe benefits from going to the lowest cost producer, then that's what we should do. And unfortunately, that's not how it worked. And of course, there's it's also not a pure economic model out there. You had China doing what they're doing, and others doing what they do. And but we've been the marketplace to the world, and it's time to kind of reverse some of that. Get the trading deficit down, get manufacturing back here, and that I think is going to be part of the next cycle. Is a lot of why commodities are going to play so well is because we are going to see manufacturing resurgence in this country. But that means building new factories, new plants. That requires a lot of steel, a lot of commodities. And unfortunately, we won't have the supply. The demand will outstrip supply and prices will go through the roof. But if you're there as an investor, you're going to be happy about that.
David Hunter explains that the coming economic cycle will reshape wealth distribution in ways many investors aren't prepared for. The weakest households will feel the downturn most immediately, but the most significant percentage losses will hit the wealthy as equities and real estate correct sharply. A 30 to 40% decline in U.S. home prices and a considerable market contraction could narrow the wealth gap, but mainly because the top is falling, not because the bottom is thriving. Hunter warns that the next decade brings rising inflation, a deep slowdown, and even the potential for a mid-2030s depression. His core message remains simple: reduce debt, secure your financial position, and position early in sectors poised to benefit from America's manufacturing rebuild and the coming commodity supercycle. These conditions may be painful, but they also create once-in-a-generation opportunities for prepared investors. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.